Good afternoon. This is Ron Brown. It's July 28th, 2023. I'm making two videos today to make up for a webinar that I attempted yesterday. Things didn't go quite right. So rather than present a disjointed video, I thought I would make two videos on two separate subjects. First of all, I'm going to talk about in-out spreads. These are option spreads, either bullish or bearish. And I'll get to the advantage of doing this, or the advantages of doing this here in a few minutes. The second video is going to be about the perfect speculator scan, and I'll explain it, and also some new user smart groups that I put together to complement and use the perfect speculator scans. As always, this is my standard risk disclaimer. And I'll just read the last two lines. Any stock, index, or ETF mentioned in this presentation is not a recommendation to buy or sell. All trading strategies are used at your own risk because, as we all know, it's a very dangerous market out there. It's great when things are going our way, but when they're not, you can lose a lot of money in a hurry. Now, I've listed a few advantages of trading in-out debit spreads, and by in-out, the in spread is in the money and the out spread is slightly out of the money, and the strike prices are pretty close. Consequently, volatility is really a non-factor because the in the money spread's volatility will be very close to the out of the money's volatility. This lets us participate in stocks and ETFs, which are capital intensive to buy outright. So we can play the large cap stocks, which would normally be out of the price range of most of us. If you're playing $200 to $400 or $500 or $600 stocks, you'd have to lay out a tremendous amount of capital, and that presents a lot of risk. If you get the direction right, you're going to make money. So it's a directional play. More time in the until expiration gives us time to be right in the trades. If the direction goes against us initially, we have more time. I usually try to go out 30 to 45 days. The minimum time frame is 9 days up, but I try to go a little bit longer. Risk is predefined and limited. The traders at TheoTrade, and I took a course from them. I was a member for a while. They buy spreads, and they're willing to take the full loss if wrong because the risk is predefined, and they consider that it's a buy and forget, and that is their stop loss. If they're wrong, they lose the whole thing. But that's just the way they play it. As soon as I enter a trade, I put a good till canceled sell stop in for a 55% profit. This will work out quite a bit if you're right on direction. Sometimes it takes a lot of time, other times it doesn't. I bought Pulte the other day, the house builder. I bought it one day, and it hit the sell stop within 1 day for a 55% profit. So it is possible. Generally, it takes longer than that. I will sell if the spread loses 50%. I do that, and you have to be consistent. If you do it, don't do it part of the time, do it all the time. The reason I do that is because it's a lot easier to make up 50% than it is to make 100%. Make up 100%, like the guys at TheoTrade. I will sell spreads earlier for less profit if the trade is stalling, or if I get a very quick profit. Like if you get a profit of 30% in a day or two, why not take it off? Because you know how quickly these trades can reverse. I say the only Greek I pay attention to is delta. That's not necessarily true, and I'll take a look at that. I also look at theta, and those are the two main trades, but primarily delta because it will tell me how much I'm going to make or lose for every dollar move in the underlying. The Thinkorswim Analyzer gives an excellent visual of what will happen with a trade over time. And this strategy, part of the reason this strategy works well now as commissions are much lower, 65 cents per contract. It wasn't that long ago that there'd be a ticket charge of $10 with some brokerage firms, and then you'd pay for the options also, like $2 or $3 per option. It was impossible to make money, but with 65 cents per contract, it's much less of a factor. Now, these are some rules that I'm posting here. Trade securities having liquid options. I have a list of the best options to trade in my non-index files. I believe I got this list from Theo Trade or Tasty Trade. Buy a call spread if bullish, buy a put spread if bearish. A minimum of 9 days until expiration, maximum of 50 days until expiration. If you think a stock is going to move right away, or if it is moving, you may want to use a shorter time frame. Strike price selection. The buy strike is in the money, the sell strike is out of the money. For bull spreads, bull debit spreads, it's in the money to the upside and out of the money on the sell side. Just reverse it for bearish spreads. When buying a $2 wide spread, pay no more than $1.05. A $2.50 wide spread, pay no more than $1.30. $5 wide spread, pay no more than $2.60. When buying a $10 wide spread, pay no more than $5.20. And the reason for this is you're taking on a certain amount of risk, and you want it to be worthwhile. If you accept much less than these amounts, it's maybe not worth the risk. When entering a spread, send the order in at the mid price of the bid ask. Be consistent. Be willing to take 100% loss on every trade, or sell when the loss is 50%. I take the 50% loss rather than hoping it will turn around. Don't trade spreads if earnings will occur during the duration of the spread. You can do that. You can trade going into earnings, but just be willing to take these spreads off if you don't want to ride out the earnings. A lot of times stocks will rally into earnings. You can make a profit and take them off and not risk the earnings roulette problem. Okay, I'm going to begin in HCSI because I want to go into the designer, and I want to show you where you can locate that list of the best options to trade. Now, this is my market analysis user groups. I don't want that. I want the non-indexed groups here, and going down here to the options list, I'm going to stop on the best securities to trade. I'm going to remove the filter by holding my shift key, and it tells me there are 74 securities in here. I'm going to transfer these to a warehouse, and then I'm going under the file menu, and I'm going to copy these to the clipboard as a comma separated list. Then I'll minimize these, and you can see that I already have the group here, but I'm just showing you how to do it. Just click on a watch list, edit this, import, paste from the clipboard, and here they are, and then replace the current symbols. So now I have the symbols which are suggested to be the best ones to trade. So the next thing you need to do is to find a stock or a ETF that you want to trade, and also the Qs are in here, QQQ and Diamond. The DIA should be in here. Here's the Diamond, and also the SPY is in here. These are highly liquid, and you can get in and out. The spreads are practically non-existent. I see I still have some old support and resistance lines on here, and it's right up at resistance, isn't it, on the weekly chart? But I'm going to sort on the percent change today and scroll up to the top. You can see that JD is on the move. How does JD look on the weekly chart? It doesn't look that good. It is basing here. Let me maximize this. And I'm going to go in and look for these three higher highs starting over here. So that would be a higher high. This is a higher high, and then when it takes this point out here, that's a higher high. So the trend, this is a price trend change. It is starting to go up. I don't really like the looks of this chart, but using that criteria, I can move over here to the daily chart and take a look at it. Obviously, it would have been better to get in here where the 3 is crossing the 6, and you can see it's moved up and it's moving higher now. But I'll just use this as an example. Let's take a look at it. Here it's a bullish on effort to rise VPA flag today. I'm going to go to add simulated trades, and you can see that there are several months, both weekly and monthly charts. Now this stock isn't that expensive. I mean, I could just buy it outright and feel comfortable doing that, but I want to take a look at this anyway. I'm going to go out 35 days and let's just look here. You can see that there's this is the volume on this option. Here's the open interest, here's the delta, here's the theta, and the bid and the ask. And let's take a look here at what we come up with on a $2 wide spread. So I'm going to hold my control key, click on the ask, and you can see that it populated down here, and then go to this strike. This one's in the money because it's shaded. This is out of the money because it's not shaded, and you can see that I have a debit here between 40 and 42 of 86 cents. Well, that's pretty cheap because on my cheat sheet it said when buying a $2 wide spread we can pay up to $1.05. This is only selling for 86 cents. Maybe the sentiment is that this stock is not going to go very far, but let's go ahead and take a look at it in the risk profile. Well, it's a little bit away from the being in the money, but you can see that this magenta line here, if I were to purchase this today and if the stock would go up, the magenta line is above the 0 line here, so it would be profitable. Now, to be in the money on expiration date, it would have to be above 40.88. The risk here is $87 on a single contract, and the reward is $113. Just look down here at the corner and you'll see the magenta line shows you how it would increase or decrease, but the cyan tells you what it would look like at expiration. Looking down here, you can see the delta is 11.53, which means for every dollar that it moves up or down, it is going to go up by $11.52. The gamma is the rate of change of the delta. Complicated, you don't really need to know that. Theta tells me how much money, if the stock price did nothing, how much it would appreciate or depreciate. Currently has a positive theta of 2 cents, and Vega's volatility change, you don't need to worry about that. Now, if somehow this would jump up 10%, the delta would change from 11.51 to 9.82 per day, but you'd have a profit of 43.71. Now, I'm going to click on 2, and let's see, the risk would be 172. Then, if I went to 3, the risk would be 258, and on a stock like this, if I wanted to take it, I would risk around $250 on the trade. I don't try to trade big numbers at my age, but I like to be in the game. So let's just put this in, but before I do that, I want to go up here, and you can change these slices to different things. So let's do the slice here where it's 0, $2 up, and $2 up, and then $5 up, and see how that changes this here. Now this is more realistic. If we get a $2 move, the I've tripled the delta because I've got 3 option contracts. And now if we get a 1 point or a $2 move, the delta goes from 34.66 to 33.28. And that's how much I would make or lose based upon a 1 point move of the underlying. Take this down a little bit, or just get rid of the price slices right now. And you want to put this in at the bid ask. It's gone up a penny since I started talking, but let's confirm it and send it. Now the midpoint, it should default to the midpoint of 87 cents. Here's the commission right here. 390 going in, it'll be 390 coming out, and max profit's 339, max loss 261. I'm just going to send it in and see if it gets filled. Now there, it got filled right away. I'm using paper money, by the way. And let's click on filled orders, and you can see it got filled at 87 cents. And that's the advantage of playing with these liquid options. Now I'm going to move to a group. I've created all these groups in this paper money, and it's going to go into debit spreads. And here it is right here. And if I open it up, it tells me the quantity, the number of days till expiration, the trade price on each of these options, what the market currently is, the market change, profit and loss since the open, it's down $1.50. Now down $3, but this is how you keep track of it. And you really need to always pay attention to how many days are left. I'm going to close this. The next thing I would do, actually I'll leave it open, and now I have to close it. I want to enter an order right now. I want to create the next thing I do after I get filled is I create a closing order. And I'm going to sell it, and then what I do is I take that 86 cents, I get my calculator out, and I change that number. What did I pay for this? I paid 87, I believe, so I multiply that times 1.55, which would give me 50% profit and take care of the commissions, maybe a little bit more. So I just take this number, 135, and make sure this is a good till canceled, and it's a limit order, and then send it. And then if I go up here to monitor working orders, you can see that it's in here for $1.35 good till credit. Here's the current market, and then I just kind of forget about it. I check them daily and see how I'm doing. But that's really all there is to it. Now I've got a bullish spread on, or a bull spread on this stock, and I've got a good fill on it. The risk reward is good. If I get filled, it'll be a 50% profit, just slightly more. And then I can go back here at any time with this in my inventory, and I can see how it's doing relative to the price. Now you can see that it slipped back a little bit. It was right here, so I'm behind a little bit on this. But this has, going back to this has 35 days to run, so I'm not real concerned about it now. Okay, let's do one more, and let's see. I'm going to look for. Let's see where weakness is today. Let's take a look at Cisco. Wow. Not good. Obviously it was a good time to sell it yesterday. I don't see any earnings down here. There must be some news on it, but let's use it. So I'm going to click on Analyze, Add Simulated Trades. This is 35 days out. And what I want to do is I want to buy the ask in the money, hold my control key down, and sell the bid 2 strikes away. And that debit is 72 cents for a 2 spreads that are 2 points apart. That's not much. Let's take a look at it. Let's look at the risk profile. Well, we're away from the strike price a little bit because of the strikes I sold, but not much. So the reward is 128 at expiration, and 72 is all I could lose if I traded a single option. And the let's bring this price slice back up here. And I'm going to set slices to this. So if it goes down, goes in my direction, I'll make $22. Delta is negative on when it's when you're on the put side, so I'd make $22.55. It's not minus $22.55. It is if it goes against you, but delta is negative, and theta is -9. So I would lose 9 cents a day if it just sat here. Okay, so I want to add some more contracts. I'm going to do 3 on here also. My maximum risk is $219. Maximum gains 381. That's really good if this stock continues down. It's had a big break and it may not go much lower, but I don't know that. So let's go ahead and lock that, confirm and send. See if we get filled. And you can go up here and monitor the trades while they're working. And here's Cisco. The market's 72.5. My limit's 73. Going to cancel, replace that order. Let's make this 72. $72.5. I'm hoping I get a fill on this. Let's just, I'm going to pause the video, see if I get filled. Let's go back and analyze it. Add simulated trades. You can see it's not nearly as liquid. The only 65 puts, only 7 puts. This is the open interest. Only 7 puts have traded on this, so there's not a lot of activity. I may have trouble getting filled on this. I'm going to hold on. I'll pause for a few minutes and see if I can get a fill. Okay, I got a fill. So now I go back to, or I stay in the monitor. My fill is up here on Cisco. You can see it right here. I'm going to move it to the group. I'm going to move it to the debit spreads. And open this up. And you can see that both of them are in here now, and there is the price. Now, what did I pay for this? 72 cents. 72 times 155 or 55% is $1.116. So I'll put it in at a $1.12. So create closing order. 1.12 good till canceled, limit order, confirm and send. Then you go up and monitor, and you can see these are both good till canceled orders, and here's the current market, and these are working. So that's all there is to it. It's really it's not a strategy that you have to have an in-depth knowledge about options. You really don't, because if you get direction right, as I mentioned earlier in the notes, you're going to make money. And it allows us to play with these bigger stocks that we normally would not touch. Now let's, before I go, let's just take a look at Apple. Analyze. Now look at the open interest and the number of trades on these Apple shares. I mean, you have no trouble getting in and out of these. And if I put QQQ in here, or SPY, let's look at QQQ, whoops. You can just see these are really liquid, and SPY is the most liquid. That's where all the action is. So if I were to go out 21 days, you can see all the open interest and all the liquidity. So you can get these filled for a penny penny difference between the bid and the ask. So those are just some ideas. Give it a try. You know what your risk is. You should be aware of ex-dividend dates. That can affect the price of a stock. It'll go down generally by the dividend amount. And then, but if you're still within the safe area or the profitable area, it may not make a big difference. And I would never hold them to until options expiration unless the options are worthless. If I let them go, don't take them off 50%. Just let them go so you don't have to pay commissions going out if you do decide to use that strategy of holding all the way through the trade. Thanks for listening. This was just really a cursory examination of it. There's TheoTrade has a course that is really in depth if you want to get into it, and also an option trader by the name of Doc Severinsen has a service. He used to be with TheoTrade, and he went on his own. I think you can join monthly and go through his courses, and then just continue after a month if you really want. He does this trading strategy a lot. Thank you for listening.